Awesome. We'll get things kicked off. So my name is Annika Havlicek. I'm the area director here at WeWork in Boston, and we're so happy to welcome everyone here. I'm sure everyone has the mutual feeling of being excited to be in person, as I do. And we're just so happy to have you in a WeWork. If it's your first time, please feel free to come over to any of us employees. Let us know. We'd be happy to show you around. For those of you who haven't been in a WeWork before, we are a global flexible workspace provider. We focus on community, service, and space. And we have 15 locations here in Boston. This is one of them in the Back Bay. And like I said, we'd be happy to show you around. So I'm gonna pass it off to Sara, who has been absolutely wonderful to work with. And I will give it to you to introduce everyone.
Joining us here today. We just want to thank our sponsors from Silicon Valley Bank. So I'm going to pass it over to say a few words. Welcome.
Thank you. This is fun. I'm Marina McGinn. Very nice to meet you all. I am on the Silicon Valley Bank team with our startup thinking practice. So we manage early stage companies in the greater Boston, New England market. A couple of things I wanted to mention. So Sara has also been really amazing, so thank you. And just bringing a cool community together. A little bit about SVB and what we do. So it's kind of an interesting practice. We've been hiring startup people to be our startup bankers. So I don't have a background in finance at all, but I do know how to review pitch decks, talk about go-to-market strategy, how to make your first hires. So if you want to have any discussions like that with SVB, just reach out to us. We're going to follow up later with an email, but yeah, we're really happy to be here. Happy to see faces again in the Boston community. Thanks.
Well, I would like to let our amazing panelists do some quick intros. I always think it's better to let them introduce themselves because everybody has some really special talents on this panel, and so I'm excited to have everyone. But we're going to talk about Fintech and blockchain and then fundraising, and a lot of what we were going to talk about, we kind of shifted over to talking about the current landscape because we've gotten some really panicked emails, especially from founders that are fundraising now and they don't understand the current climate. So we're going to spend a little time talking about that generally, and then specifically for Fintech and blockchain because of all the crypto changes. So with that, I'm going to pass it over to Michal.
Thank you. Hi everyone, my name is Michal Gilonyanai. It's a bit of a hard name to pronounce in English. I'm Israeli. I was born and raised in Israel. I've been living in the US for many years, and I'm now a partner at two Lanterns Venture Partners, early stage venture capital fund that was founded by John Hawthorne, who is sitting here in the front row, a longtime friend of mine and colleague. I'm based in New York, usually, and I'll be happy to tell you a lot more about the fund and what we do as we go in the panel.
Hey everybody, nice to see some of you again, and nice to meet those of you who I have not met yet. My name is Katie. I work at an early stage venture firm in Boston called Pillar. We do pre-seed and seed, and about a third of our investments are in crypto and blockchain startups, so happy to chat about that today. I am Senofer Mendoza, founding GP of Mendoza Ventures here in Boston. We invest in AI, Fintech, and cybersecurity internationally, starting in pre-seed and seed, and we're in market with a $100 million growth stage fund. Sarah, do you try to see?
I am Sara Letterman. I'm one of the founding GPs at 3+ Ventures. I've been a founder 3 times, and we are generalists, but we love Web3. I've been working on blockchain projects since 2016, so this is really near and dear to my heart. So I guess my first question is, I would like to just your general sense of where the market is right now and what you're excited about in the current climate. So I guess we'll just start.
Sure. So It looks definitely like things are beginning to cool down a little bit in, in the public markets for sure, but it is beginning to trickle down to funding for startups as well. Not so much yet from what we've seen in the very early stages, but we anticipate that to arrive too in the next few months. And sort of the general atmosphere is a bit of the beginning of a panic around that. We're still definitely very excited to be investing, and especially in the early stages, because we see so much great energy and so many great teams and great products being created. So I think, in a sense, these kinds of times are the best times for the best startups to stand out. So if you have conviction that you're building real value and that your team is strong and is the right team to, address the challenges that you're addressing, I think it's a very optimistic time to be a founder.
So, to follow up, Katie, what are you seeing specifically in like crypto and blockchain, and what of that is interesting to you, and where do you feel like the turmoil might be going?
Yeah, sure. I think very similar. For those of you who follow the crypto and blockchain markets, you will have seen the Terra explosion earlier this week, which was a little bit of an explosion, so to speak. And so I think that's going to definitely have some impacts in the market. You've already seen the crypto markets coming down since early January 2022, sorry, geez. But I do think there's still a lot of room to build, and I think for those people who believe that Web3 is going to be, the next wave of the internet, as we do at Pillar, and as a lot of our founders and builders do, I think some really great, interesting companies will be built. But I kind of echo your comments around you need to start with some real traction and really make sure that you have a good plan to revenue and a path forward. But I think within like specific industries, I'm particularly excited about any infrastructure that's being built, DeFi protocols, layer 1 applications, and decentralized apps that are being built right now.
And my follow-up for you is, what can female founders do right now to help sort of differentiate themselves in the current climate, especially in terms of like blockchain and fintech fundraising? What are you seeing that's really helping women sort of get that leg up, or just what are they doing differently that you're excited about?
I think what I see female founders doing that they've always done is have a real business behind your pitch deck, and that will differentiate you in this market. We have reached the Duchampian era of private equity, where we are doing capital for capital's sake. Parts of Web3 are definitely a product of meta marketing Web3 as the next wave of the web. And I have not seen such a divide come out of Silicon Valley between user adoption and venture funding since the time of Web3. So we're really excited about real life applications of blockchain that are getting to the users. And if you have an application that can withstand a solid recession, which female founders tend to anyway, then that will differentiate you in this market.
So as a generalist, specifically, like what are you seeing in different areas that are still moving forward really well?
So we are a generalist fund. We invest mostly in software. We have a few companies that also have hardware components in their products. And I think what excites us the most are some industries that haven't been disrupted yet, and that new technologies are enabling disruption and some, acceptance that has taken a longer time to come. So we've made investments in the industrial space. We've made investments in shipping, in insurance, and industries that were sort of slowly coming around to adopting innovation. And I think even in this new world of Web3 and blockchain, there's so much still unknown that, there's a lot of infrastructure still to build, and a lot of early adopters who are seeing the coolness and all the opportunity, but I think a whole range of additional applications that we can't even dream about yet. So when we see original thinkers and ideas, that excites us generally.
And specifically, like when you're looking at decks and projects, what are you looking for, and what is setting founders apart in terms of what they have done. Because one of the questions we get a lot is like, we're building in this new space. There's not a lot of examples of what investors want to see in decks or what they're looking for in white paper. So if you could just give us an overview of what you've seen that founders are doing really well in their pitches and in their decks, that would be super helpful.
Yeah, so I think at the early stage, a lot of it comes down to the founder and the founding team. And at least at Pillar, we're very founder-driven investors. And when we're looking at startups, we want to know, like, why are you uniquely qualified to build this business? And so that can come in a number of different ways. It doesn't necessarily mean that you built a company before. It doesn't necessarily mean that you worked at State Street or whatever it may be. But we look more for qualities, and we'll ask specific questions in our pitches to get to some of those. But some examples of that are like, do you run through walls? Is what we say. So like, being a founder is really hard, and we want to know that you can run through a wall and kind of do what you need to do to make stuff happen for your company. The next is kind of the idea of resiliency. So, like I said, it's really hard. You're going to get knocked down 9 times. Where in your life have you shown that you can stand up again and again? Another is ability to get people to join you in your parade, is the way we kind of say it internally. But the idea is that as a founder, you're really a salesperson. You're trying to sell talent. You're trying to sell investors. You're selling all day long, you're trying to sell customers. And so where in your life have you demonstrated that you can get people to come along with you on your journey, whether it be a previous company that you started, or whether it was like, a club you started in school, whatever it might look like for you. Those are just some of the qualities that we look for in a founder. And I know that has nothing to do with a specific deck, but at the end of the day, we really do think like, this is the right team to build a company, they'll display all of those qualities. So we spend a lot of time on that in kind of one-on-one conversations with the founder as a human and as a person.
Yeah. At the early stage, a lot is on the founder, which is why we intentionally diversified our investment committee. Because if you're a woman or a person of color going up against an investment committee that's homogenous in any way whatsoever, then you will not be seen as resilient in the eyes of that investment committee. And so that is the number one thing I think VCs can do to meet the market where it is right now. But also traction is impossible to be ignored. So yes, it is always great. I call it the male Cinderella story of like, I had this awesome idea. I did the voice. This isn't being broadcast, is it? And then I got funded, and then I exited because it was amazing. Like that is the male Cinderella story that we're fed in startups. And so that is the pattern that a lot of people look for, but you cannot ignore $3 million of ARR. That will find money.
I want to add on there for B2B SaaS, the average time for traction is 5 to 7 years. So anyone who thinks in 12 months that they're going to be like rocking and rolling, I just want to tell you it's a long haul. But with that in mind, like I think a lot of founders get nervous, especially female founders, when their MRR is low or they're like, I don't know where I fit in. What are some of the differentiators that you look for, especially with underrepresented founders or under-networked founders, that give you indicators of traction when they don't necessarily have revenue?
I think some indications of traction can be initial reactions and reviews that they have from first customers, for example. So we might ask to speak to some first customers to hear what they think. It could be that we know through their prior experiences that they have access to a certain community that other founders don't, specifically based on their different background. So it could be different things. It's kind of very specific depending on the founder and the business, but I think there are ways, obviously the number of users that you get on the platform if it's free, and the typical Web 2 kind of numbers that we used to look at for traction still apply here, at least in some cases, but if they don't, we try to look for additional metrics.
Yeah, I kind of echo that. I think in the Web3 space, a community is a really important aspect. any Web3 protocol or business. So we look to see, how many users are in your Discord, how many are actually active, and how many people may have, been engaged with you over some amount of time. I think it's actually very rare that we see companies with revenue. So I think we're oftentimes looking at a lot of the metrics you mentioned, but then those are just a few additional ones. But I'd say at least for us, we're very comfortable investing in companies without revenue, and honestly, we expect that. And as long as you have a plan to how you're going to monetize your community or your, whatever it may be in the future, I think we're okay with that.
The number one tell for us is if you can do as a founder what you say you're going to do over time. So we track our companies. Typical VC diligence is about 2 weeks, maybe a month. We track our companies over 3 to 6 months. And if the founder does what they say is they're going to do, if they celebrate successes, if they ask for help with failures, that is the number one tell for us, because no matter what your background is or what your projected traction is for the year, at the end of that, we know if we can work together as a team. We know if you're telling us the truth, usually. You can't, it's like dating, you can look good for a week, but you can't look good for 3 to 6 months.
So then my follow-up has been, and we've heard this even today, which is I'm not sure how much I should be raising in the current climate, and what do I need to be prepared for? And that's a really large question. So I'd love for you, especially with fintech where products take more time, usually aren't revenue generating immediately, what should founders be looking for to raise, and should they be increasing their raises or decreasing their raises? And generally, how should they be looking at the market right now?
I would say it's really company dependent. I think you have to take a close look at your plan, at your hiring plan, and what you want to do in the next 18 months, and take a real look at your budget and say, is this what I actually need? And if you're like, oh, maybe I actually need some more, then you might want to increase your raise. And if you're like, well, this is kind of best case scenario, then maybe you want to decrease your raise. But I think that now is the time for founders to be honest with themselves about how much do they actually need to hit the milestones that they want to hit in an 18-month time frame. The second thing I will add, kind of a caveat, is that in a lot of the bigger downturns we've seen in the past, it's taken about 9 to 10 quarters to really hit the bottom. And if you think that we're at the top of that now, consider, do you want to raise a little bit more to kind of last you through that if you can't raise for 2.5 years? Hopefully, like you were saying, there's some real traction and real businesses, and the best companies will still get funded regardless. But it's a time to really have an inward look at yourself and your company and think about, what is this going to take over the next 2.5 years?
100% do what your company needs first, and that is an appropriate raise. Do not try and react to a crazy pants market to try and run your company, because that is a quick way to run yourself broke and bothered.
Yeah, I totally agree that you should look at the needs on the budgeting side first. And then I would say at a time like this, do a worst case scenario analysis of the least that you need to achieve, the minimum milestones that you'll need to show for the next round. And declare that as what you're raising. If you manage to then bring in more than that, all the better, because during a time like this, if you can raise more to sustain you longer, that's only good. But start from that worst case scenario as a minimum, because otherwise you're kind of shooting yourself in the foot.
Okay, then back to early stage, because most of our founders are raising their first rounds. There is still a lot of early stage money that has to be deployed. So I was wondering if you can talk really quickly about the difference between early stage and later stage, and how founders should plan for the long haul of this.
I have so many thoughts. So early, first of all, I want to be careful because I think our tone is a little bit like the market is falling, but people put money into private equity in times of economic downturn for really good reasons. It's a long-term investment. And so yes, people might be pulling back on the riskiest sliver of their private equity portfolio, which is venture capital, but there is still money in VC to be deployed. LPs are still allocating to VC. Our industry as a whole is looking very healthy for the next couple of years. So let me just say that. And then really the difference between an A round and earlier stage is sales. That is 100% the key differentiator. That is a common thread amongst all VCs. For us, those sales look like $2 million ARR, plus or minus. Every VC has their own metric of what they think an A round should be, which is why you get all these cool terms coming out like seed and seed 2 and super seed and baby A and super A. So depending on where those metrics fall. And then the B round is solid metrics. Like you are definitely have a viable business that is at profitability or approaching profitability, and you're injecting capital to accelerate that.
So with that in mind, I would love for you, if you can talk for a second about I want to correct that there is a lot of pre-seed money out there, and there's been some huge funds, and those funds still have to be deployed. If you think there's a difference in how they're going to be deployed over the next year, or if they're going to stay on track, because AngelList and PitchBook are all saying investments in April, we're on track with January, February, and March. So do you see, those early stages kind of staying on track? And then if that's the case, should founders really be changing much, or should they just be moving forward kind of as is? And if they should be changing, kind of what are the things that people think they should be adjusting for?
It's really hard to tell, obviously, but most of the time when people start talking about a slowdown, it happens. I don't know if it's a self-fulfilling prophecy because people scare each other into sort of holding off, or it's really, the objective conditions of the market that dictate that. But I think, I personally think that things will slow down a little bit, whether it is in the level of investments or the pace or the valuations or both. Because we've seen some crazy valuations in the pre-seed and seed stages in the past few years, and a lot of people think it's actually good that there will be some correction, because I think a lot of founders don't realize it's a double-edged sword. Again, when you think about the later rounds, if you're expected to pretty much at least double, sometimes triple your sales and double your value in each round, if you start too high, it's a bit of a problem oftentimes to get to those milestones. So I think correction is good in many ways. I do think, again, that it will happen, but you're right, the metrics so far show that investments are on pace. So maybe it is just, smoke without a fire. I don't know.
I was definitely going to say the second part as well, around if you're expected to double your valuation every round, going out right now and getting the highest valuation possible, maybe it's right for your business, but it also might not be, and you think hard about that because it's hard. Yeah.
I have a follow-up for you, especially in regards, like whenever there's question of what the economy is doing, and obviously with the instability in crypto and stuff, what can specifically fintech founders be doing for, to assure, what should they be thinking about in terms of, long-term strategy for, making it through whatever this next, 12, 24 months looks like?
Yeah, it was interesting when you said, look at the VC market. Also look at your customer market. I would probably not open like a luxury makeup for the middle class this year. I don't think that would be a great business plan to launch with. But for fintech,
this is not legal or financial advice.
Yes. Past performance is not indicative of future advice. Exactly. Like that's where I see, I may spend less at Sephora this year, hopefully. And so I think if you have a really solid value proposition and you get to traction on that value proposition fast, those are the things about business that you can't ignore. You almost have to go back to B school and say, okay, am I going to depend on the venture market for subsequent rounds of funding to up the valuation of my business and get an exit, which is a strategy that has worked for some people. It's not working well for the retail investors right now. Or am I going to have a solid value proposition that I can fall back on? 80% of our portfolio is underrepresented founders. We always tell them to have that back door open, because if you're depending on an industry that doesn't look like you for money, your chances are less of getting it. And so you always have to have that solid business case underneath so that, yeah, you may not blitz scale the way that you want to, but you can still grow a business.
I guess one of the things that I always say to founders is look at what your advantages could be if the market doesn't go the way that you want it to. So I guess one of the things that we're looking at is crypto, which is getting hit really hard. So in terms of blockchain, like where are you telling your founders who are in the midst of really starting and or have just gotten investment, what are you telling them, portfolio companies, to really watch out for and look for, and what should they have on their radar that might be a blind spot right now?
Yeah, I think one of the big things is hiring. I think when the market also gets a little scary, people like to stay put a little bit more, and especially when you're an early stage founder, hiring is one of the most important things. And so just keeping an eye out for that. I think there are still people who are looking to make the jump from Web 2 to Web 3, and so I don't think it's like, go crazy yet, but I think it's definitely something to look out for. And then I think, we've kind of said this earlier tonight, but what is your plan if you can't raise money in the next 18 months? And what does it look like if, Terra exploded and Bitcoin goes to zero? I don't think this is going to happen, but if Bitcoin goes to zero, it's really something to think about. What if, especially in Web3, but I think our founders are thinking about this, is what role does regulation have in these markets too? And especially because, $50 billion worth of value was just evaporated overnight this week. I think that definitely catches regulators' attention. And so if, next week they say no cryptocurrency can exist anymore, it's all securities, etc., how does that change, crypto businesses? I think the answer is probably a lot.
Yeah, I have a follow-up on that, because we do get this quite a bit from founders, is what do you look for them in kind of their checklist, legal, regulatory, what are the components that you really look for when you look at an early stage company that's building in this space in terms of DAOs and anyone who's doing sort of platforms for trading? What are you looking for that they've hit those checklists, at least have done or are in compliance with? What are those things that you really?
Yeah, I think number one for us is just making sure that they have good counsel. And making sure that they're hitting all of, they have a really good lawyer that can guide them through all of that kind of process, and a lawyer that's comfortable with the state of regulation. I think some crypto lawyers are like, no, you can't do that, no, you shouldn't do that, that's too scary, blah, blah, blah. And then there's another flavor of lawyer who's like, okay, well, if you did that, it might be a $10,000 fine, but, and so kind of finding counsel who's not too strict and won't let you do anything, but also not someone who's going to let you do, whatever you want and end up where, somewhere where you don't want to be. And so definitely having good counsel is one. And then a lot of it comes down to transparency as well, especially in the financial markets and what you're marketing to people and what you say. And so making sure that they're going through a checklist and not, promising things that aren't necessarily true or that they can't back up. So that's another good thing.
Yeah, are we gonna be able to ask? Yes, there will be questions. Probably after the next round. So in Web3 specifically, companies that are raising, are you looking for white papers? Because this is another question we get a lot. And then are you also looking for an abbreviated investor memo along with the deck or a longer explanation? Or are you just looking initially for that short deck? Because a lot of founders are getting confused because they're getting a lot of pushback on both sides, and they're like, I don't know what I need for fundraising for this space because it is so new and there's not a lot of good examples out there.
bless the VC that will sit there and read an entire white paper. Like, that is not Mendoza Ventures, just so that you know. I think for any key differentiator in any space, a white paper can be very validating, especially if you've presented it at a conference that's renowned as an expert in your field. Usually that's what VCs are looking for because we are learning Web3 along with everybody else. I think the caveat I would add to that is be very careful of educating the VCs at the cost of your time. If a VC needs to be that educated on Web3 and you have a Web3 company, they are not your VC. And there is an exercise that we call Go Find a Rock, where we are humans, we don't like to say no. We say, well, maybe if you had a white paper and then you come back with a white paper. It's like, no, I want a purple rock. Go find a purple rock. And then the founder comes back with a purple rock. And it ends up this endless exercise. So I would make sure that if you're getting asked for a very specific checklist, when you are an expert in your field, to start revalidating up the chain to make sure that they're the VC for you.
Is there something specific?
We haven't actually seen so many, but we're not that active yet in Web3 in particular. Again, sort of across the board software. So it's not something that we've had to deal with so much. We've gotten a couple here and there. It's true that it's not always the first thing that we read. But if we do deeper diligence, obviously we will.
Answer that one too. Yeah, so I think it depends on the type of Web3 business that you're building and crypto business that you're building. Crypto is huge. There's so many sectors even within crypto. If you're building a layer 1 protocol and it's based on the technology, then yes, we probably want to see a white paper. But if you're building, a marketplace business and it looks really a lot like a traditional tech company, but you happen to be selling NFTs, then you don't really need a white paper. So it kind of depends on your products too. So keep that in mind.
And then what are some things that you're looking for specifically that you want to see in decks? Because we get that. This is a question that has come up, and I probably got a dozen questions from people excited for today's panel because they really want to know what are the key things that you want a checklist in the decks for especially blockchain projects.
Okay, we have 5 questions that we always hope that every deck answers. The first is who will buy it and why. So, what's the problem? Who's your customer? The second is how much can you sell? Also, these are framed in like a physical product, but applied to your industry. The third is what are the unit economics? Can you make money on each thing that you sell? The fourth is, can you defend the profits? So what's your moat? And the last is it a good deal? So if you can answer all 5 of those questions in your deck, we are very happy people by the end of the conversation.
I would say there's so much good stuff out there on decks. The number one thing that turns me off is if it's not telling a story. Like, what is the story of your company? Have you cohesively told us how you got here and why and with who? That's the number one thing. I would say even more than the deck though, look at who you're talking to before you take the meeting with the VC. It turns off all of our partners really quickly when someone walks in and asks me what I do at the firm. And I have to explain to them that I founded it. And it's not even, maybe they didn't have the time or something happened. It's usually not me that will give them the second chance. It's all the advocates sitting around me in the room that won't let it go past that. So make sure that you take some time to figure out who you're meeting with so that you're catering your conversation to that person.
Okay, so one of the things, obviously, we're really focused on female founders, and a lot of female founders are facing implicit bias. Some of that's pretty overt too. And what are a couple of things that you would, as women in venture, tell women that they should be making sure they do when they get those questions? How do they turn them around, or what are some ways that you approach things differently?
I think a lot of the bias is self-bias oftentimes with women, and that's a big issue to overcome. It's definitely something that I felt over the years in my own career. And I think, there are always these jokes about, job descriptions that have 10 things in them, and if a man has 5, he thinks he's the perfect fit. If a woman has 9, she'll never even apply. So I think, a lot of women don't even initiate a meeting or reach out to a VC until they think the deck is perfect and they have everything they need and they have enough traction to show or whatever it is that they think that we're looking for. So I would recommend just, trying to overcome that and sending that email and trying to get a meeting, and usually going through someone who knows us is the best way, because that, personal connection definitely makes a difference. But if we're, not too busy, we'll even take, meetings as much as possible that come through cold emails or LinkedIn messages, because we do definitely want to try to give opportunity as much as we can, especially to founders that we know usually don't have the guts to initiate that connection. So we'll almost 100% take cold emails from populations that are typically underrepresented. In all other cases, we'll always take a meeting if you come through someone that we know. So it also shows that you made a bit of an effort, to get to us in a way that, will kind of get our attention.
I think one of the things I would add is look at the makeup of the firm and the investors at the firm. And, that was something, just thinking, yeah, if the investing team is all white men and you're, a female or underrepresented founder trying to pitch that firm, they had the opportunity to hire women investors too. They had the opportunity to hire underrepresented investors, and for whatever reason, it's not, they're not on their investing team. And so, I don't know, the advice I give is, how bad do you really need money from, I know it's really hard to raise money, but I always say, go look for the firms who have women in leadership positions. And I think you'll find that you have better success with those people. And I think if you're in that situation, also reaching out to the female GP or the female principal on the team, and asking for a meeting with them specifically. And if it's not the right fit, they can transfer you to the right person on the team. But more often than not, I think women are always willing to help women too. And so that's one piece of advice.
VCs love to brag. We all love to brag about our companies. All of us put all of our companies on our website to brag about them. That is the only reason that they're there. Look at our track record. If they have not funded a person of color yet, it's 2022. It's not because they haven't met one. If they haven't funded a woman yet, 1% of all GPs at all are female. And that is not an inclusive 1%. That is the 1% that went to Stanford, MIT, and Harvard in that as well. So just because there are women at the firm does not mean that they sit on investment committee. It does not mean that they can advocate for a deal and get it through committee. So look at the track record, because that's where they put their money.
So we always tell founders to do their research, and that's not hard. Crunchbase and some other places really give you access to that. And then this is the follow-up to what you were talking about with cold outreach. What are some ways that under-networked founders, which women typically fall into this pool almost exclusively all the time, how are some ways that you've seen women especially build network within DC, which feels really closed in some markets, especially Boston being one of them, feel also even smaller and more closed off to a majority of founders? What are some ways that they can really build network effectively with the community?
Abigail, can I call you out? Abigail is an associate at Hyperplane, which is a local firm in Boston. They're awesome. She is a savage networker, and she stalked me and figured out that I went to UMass. And so she said, hey, I want to work in VC, and I saw that you went to UMass, which, FYI, everybody assumes I didn't go to state school, so no one knows that about me. And she messaged me, and we had coffee, and I did not have a position open for her at the time, which I'm still stabbing myself for. But I introduced her to some friends, and made a warm introduction to get her first job at a firm in Boston. You need to unabashedly get yourself in front of the people that you want to work with, and in an appropriate and polite way.
The one thing I would add is after every networking meeting that you have, so you finally get a call to someone, you get a coffee meeting, ask them who are 3 people that you would recommend I reach out to. You know, is there anyone in your network that you'd be willing to connect me with that you think would be a good fit for me to talk to? And that really quickly scales if you have 5 coffee meetings and you're asking them each for 3 introductions. It really becomes kind of an exponential curve pretty quickly.
Yeah, I think those are great ideas. I would also add that for founders from those groups, I think accelerator programs are a great way to get connections, especially ones like Mass Challenge, which John founded, which is a nonprofit and doesn't take any equity from the founders, but gives an amazing array of education and mentors and connections to investors and to other potential advisors. So I think the acceleration programs are really a great place to start building a network too.
And events like these with other women who will connect you to other amazing women. I'll just throw that in there. Well, I want to say thank you. I know there's some questions, so I would love to pass the mic around for questions. And I'm going to let Renata start because she had one legitimate here.
Well done, Sarah, and thank you for everyone for coming, and this has been awesome to be here, and thank you for your wisdom. I'm curious about investing in Web3, and for the companies that you're looking at that are Web2, potentially can move into Web3, what kinds of, other than the 5 things in the pitch deck and all the normal things that we all look for, because I'm also VC starting out, what are key metrics that you look at, or what questions do you ask founders at the early stage in terms of their transition from Web 2 to Web 3? Because I'm learning about Web 3 as a VC, but I'm also asking the right questions of, I understand it's community, but because it's such an early time and founders would probably have to move into that space, what are you asking? What are the questions that you're asking?
I'm definitely not a Web3 expert, but I think what I would be asking as we begin to see more and more of these companies is community is one thing. Another thing is interoperability, which will be a huge requirement in Web3 so that the vision can be realized, that people can move between different platforms. And I think there's a lot of sort of bridging solutions that are going to be needed between Web 2 and Web 3 that would be interesting to think about as a founder, even if you're not building them. How would you connect to them? Where would you seek them?
I think the one thing we ask is why? Like, why are you doing this? I think there are a lot of companies who are like, oh, well, wouldn't it be great if we launched an NFT now? And it's like, but do you need to? Like, really think hard about, like, why are you trying to get into Web3? Is it because of the actual value proposition and what you believe Web3 can, and the core primitives of crypto can bring to your business, or is it because you see an opportunity with the hype and potential fundraising and things like that? So I think, like, I know that's a pretty basic question, but I really like to see that people have a good answer as to why they really think that transitioning from Web 2 into their Web 3 company is going to make a big impact on the value that they're able to provide to their customers, to their users, or that kind of thing. So.
Are you saying everything doesn't need a token?
I don't think so.
That was like having a moment in our office right now, so everything needs a token. I would also say, who's their Web3 network is my number one. It's still a pretty niche group of people that are building Web3, and if you don't have access to that network of developers, and if you can't recruit those engineers, you're dead in the water. And also, I don't want to sound like a wicked Bostonian, but beware of the Valley buzz, and don't just do it because it's like in the air. And so that's mainly what we're looking for, is like, is this a real use case?
And I'm going to give an example just because to make it more tangible, because I appreciate, I know it's a hard question to come up with a solid answer, but for example, in the fashion, let's just take fashion, for example, Louis Vuitton, because they're not a startup, but they're trying to do like buy a Louis Vuitton in the Metaverse, and we'll also ship you a Louis Vuitton purse. I'm saying that's like bridging real world with the Metaverse. So that's a real specific. So I'm saying there's companies out there that don't want to miss out, but they also see the shift. They're leveraging what's happening in real time with, I mean, you look at I have kids that are playing, video games, and their life is in this metaverse. So how are brands, how are startups thinking about, forget about crypto or NFTs, forget about NFTs. Let's talk about metaverse, like digital world versus real world. That's another Web3. So I just wanted to make it more tangible, the question more tangible with the beauty industry, the fashion industry.
Yeah, I think we call it Web 2.5, which is kind of like the intersection of like traditional companies that are Web 2 and, adding Web3 components to it. I think if they're going into the metaverse, one of the things we like to think about, and especially if they are going to have a token, is like, what is their token economic structure? And what is, how are they creating an economy within the metaverse that's sustainable? And that's another thing that we look a lot at. So, tokenomics. Yeah, go for it.
We had a company pitch us recently where the token had outperformed the valuation of the company. Like the token was, and we were like, well, did we get some token? And they were like, no. And I was like, no, thank you. So I think whenever you see that disconnect, it's a red flag.
Can I throw one thing in there that I look for that hasn't been mentioned? But I look for churn. Because you have to have a long-term strategy for keeping people on the platform. And that's the same with Web 2 businesses. That's a huge thing for SaaS, and I come from SaaS, so I always look at like, what is your long-term strategy for keeping people engaged? Because there's going to be metaverses popping up all over the place. And how are you going to keep people in your metaverse? And how are you going to keep them coming back? Because it's the same thing for Discord channels. I look at churn on Discord really heavily.
All right, I'll go really fast. So I had a founder ask me this question recently, which is, when I get a no from a VC, how do I engage that VC moving forward? Do they want me to throw them on my investor update? How do you guys like to kind of engage that?
Usually when we do want to continue to engage and we think it's just too early still, or we'd like to see a bit more traction or a bit more development, we'll ask to stay in touch, and we'll say, we'd love to see how you progress. Please keep us in the loop, and we'll actively ask for it. If we don't, it's usually not the case so much that we think we're going to change our minds. So in our case, at least, we try to be clear about it.
I would agree with that. I wouldn't add them to it unless they specifically have been asked to add to the investor updates. And I think VCs will usually be pretty clear if it's a no or a maybe later.
Yeah, to all of that. And then also keep in their network if you're going to be raising later. I said no to a company 4 years ago that we invested in last year, and it's one of our highest performing portfolio companies. I said no to another company, and they let me know what their thoughts were. And we won't be investing in that company in the future. So be careful how you handle the no, because you still have to work with these people.
How much time should founders be spending on compliance? So, it's needed for a bank account, it's needed for working with large enterprises, but it also takes a lot of time and resources. And the second part of that question is specifically for founders who may not have the resources to have a really great lawyer and are super early stage. What advice would you give them?
Drop your price point to make it in under compliance. So we work in cybersecurity and fintech, and we sell to a lot of big corporations. Usually under 50K goes on a credit card. So while you can cover your ears, give it recovering states for your but while if you can keep your price point low enough, you usually don't have to hit all the compliance checkpoints, and you can run a beta at a lower price point while you also kick off that process. So we do like a try before you buy, sell. We do it at the lower price point. At the end of whatever period, they can buy in at a higher price point. It gives you time to prove your worth while you're doing compliance and gives you some income.
To your question on lawyers, a lot of lawyers will actually defer legal fees until after you raise. And so if you find a legal firm that does that, a lot of the big firms will do that, and they almost look at it similar to a VC investor would. Like, if we believe this company is going to be successful, they're going to pay us a hell of a lot of money in the coming years, so we'll give it to them for free for now, and then defer those fees until later on. So there's actually a lot of good ways to have a lawyer for free in the early days.
Yeah, I think that's right. So I think some of the law firms even convert that into equity at some point, rather than getting the deferred payments. That's more unique, but I've heard of that as well.
Just a warning flag on that as an ex-founder, a lot of the times those terms come with interest, and so when you do raise, you end up writing your law firm a really big check. So make sure that you put that into your raise and be clear with your investors, because investors need to know if there's that's called a liability. If there's basically like an outstanding bill for the company that needs to be part of your raise.
Hi, my question is for Senofer. So I was a Mass Challenge mentor for a Brazilian Fintech co-founded by a woman, and fortunately they raised a Series A round led by Tiger Global Management. But then after that, Tiger has now had losses of at least 17 billion. And SoftBank is also losing a lot of money. Do you think these mega funders are going to trickle down to affect the chances of raising the Series B in Fintech?
I've heard a few stories like that, and a lot of that is because those big funds raised a lot of money and had to deploy very quickly. And so a lot of startups got funded. And I think also at the same time, in the past 2 years, we have this new ecosystem of micro funds with the most diverse GP set that we've ever had. Exactly to your point, what we're seeing is that capital is not meeting them at the growth stage. So there's a bit of a valley now for diverse representation, not a bit of a valley, a huge valley for diverse representation at the A round and beyond. And so we're hearing a lot of stories like that come up, which is why we're raising a larger fund, honestly, to meet the market where it is.
I have a follow-up for all of you on that, is how much do you reserve for follow-on for your early stage investments, if you do?
We reserve about half our fund for follow-on.
Similar.
Similar and even a little bit more.
And then, say you're investing today in companies that are either going to get acquired or IPO, hopefully, in the next 5 to 7 years. So how do you balance what's trendy and popular today versus where you expect the market to go in the future?
At least for us in crypto and Web3, our whole bet is on 5 to 10 years from now. I mean, if you look at the crypto industry today, like 8% of the population has even used blockchain and is invested in cryptocurrency. So yes, it's still like hot today because I think we're in a little bit of a bubble in Boston and on crypto Twitter or tech Twitter. But when you actually look at like the middle of America, like most people haven't used cryptocurrency. So when we're investing in crypto and blockchain Web3 companies, we're actually betting that in 5 to 7 to 10 years from now, that's going to be more widespread, bigger adoption. So that's kind of our bet in the market there, because like right now, it's pretty small relative to what I think it can be.
We've been investing since 2016 in fintech, blockchain, AI, and cyber because we're geeks from Boston. And so I actually got called out on Twitter for this because someone tweeted, "I miss when fintech was boring." And I was like, "Me too." And then he was like, "But it's more inclusive." And I was like, "Come on." Because it used to be like we were not the cool VCs. And now it's picked up in the valley and coming to a peak there, I think. And so we've always had this longer term view of who's actually using it, and that shelters you from some of that.
Okay, all right. I have a question about selling shovels in this Web3 world. So like, what do you consider as shovels in this world where the gold mine is in Web3?
Shovels as in like infrastructure?
Yeah, like things that any Web3 company would need.
Yeah. I think like right now DAO tooling is pretty hot. So if the world, and as you don't know, DAO is a decentralized autonomous organization. A lot of people think they might one day replace the company structure, but right now it's a hot mess, and there's no way to pay people. There's no like parental leave. It's just so messy, and so I think that's an interesting use case right now. Is I think if that's going to be true, we're going to need a lot of infrastructure and systems in place in order to make those organizations run as actual organizations and not group projects with a bank account. And so I think that's one shovel. If you guys have others to add.
Yeah, I kind of see Web3 still as a group project with a bank account. It's just a really big bank account. And I think where it starts to hit the world, like we're really watching what's happening in Central America with the adoption of crypto as a currency to see, because imagine if you could audit the government. I think we'd all like to do that the past couple of years. And seeing where that adoption really hits the road in terms of international industry is where we're watching for. Although if you're still gold mining with a shovel, I think there's a lot to talk about.
I actually think that's a really interesting point about Latin America and developing markets too. I think it's like 85 to 90% of people in Latin America have a smartphone, and like only 25% have a bank account. And so when you think about the fact that a lot of people's first experience with modern financial tools will be with crypto and blockchain, I think that's a huge opportunity and something we're really excited about.
And it's an opportunity with amazing precedent. This happened in Eastern Asia in like 2008, where we skipped most of Asia skipped the desktop experience and went straight to mobile, and it completely changed how all of mobile is designed now. And I think everyone's recognizing that Latin America has a lot of free regulation and not a lot of infrastructure in place. And so that's why there's so much private equity capital going there now.
I feel like every startup has some sort of fintech component to it now, whether it's payments or some other aspect. Can each of you define like what truly is a fintech company, and how can startups determine like, am I actually in the right sector, going towards the right VCs, or am I building a consumer product that has a fintech aspect to it?
We're seeing a lot of that too. And I think some of that is a byproduct of the buzz in the Valley of like, it is helpful to pitch as a fintech now. And so that kind of idea has been adopted, but we really see it as, is the management of finance integral to the product? Like, is it actually changing a financial life? Like our blockchain company does post-trade settlement on blockchain. That is a fintech. I saw one recently that was an instant quote, but really it was an AI company, you know, who could like take a picture of something and create a quote from it, but then they also were connecting you to potential loan. That's an AI company with a marketplace tacked on the back end of it. So we really look at the core of the company and is it true to the, you know, the pillars of the company.
Yeah, I don't have much to add. I think it's true that it's the core capabilities that really make a difference in how you define yourself. And if it's just an add-on like the NFTs to make yourself a Web3 company, it's not as authentic as if your whole value proposition is sort of targeted towards solving a finance issue.
This is more of a VC question and diversity in VC. With the whole, I think I heard it on Twitter, or people have been talking about the future of VC in terms of the legal structure and as it relates to DAOs and potentially having a VC structured as a DAO. I don't know if that's possible, but potentially. And also as it relates to having more diverse investors and having more women and capital and quite frankly, minority and women running funds. So we invest in underrepresented founders. I know there's a lot of work with several fellow fund managers who are working on the definition of accredited investor to get more smaller check sizes in VCs. Could you talk a little about what you see the future of VC in terms of, as it relates to DAOs, setting it up in a DAO, or even just getting more, let's call it decentralization from the venture side?
I can't talk much about DAOs simply because I don't know that structure well enough myself, but I think we see the beginnings of that sort of more democratic access to investing on the crowdfunding platforms for the past decade or so to varying levels of success. So I think the key here is to have those managed in a way that will lead to successes that will bring more people to those platforms. And I think, whether it's DAO or another structure, I don't know, but it's definitely the way things should go.
I like this question. I think, we're constantly thinking about how can we put ourselves out of business in the next few years, and how can we be in front of that, of course, so that we still exist, but maybe in a different form. And I think DAOs are one potential great way to do it, but I think right now there's still a lot of legal questions to figure out. And there's just not a lot of regulation yet as to what that looks like. So I know people are getting involved in investing DAOs. It's unclear to me how to make sure those returns come back equally over time. How to make sure that if something hits the fan, like the liability question, that you're not personally responsible for something that happened. And so there's a few workarounds around that. Like some people have set up an LLC for themselves before they join an investing DAO. And so there's a bunch of ways that people have started to do it, and I think it's great. I think having more people with checks can only lead to more diverse founders, diverse representation in investors, and I think it's something that would be great to do. I just think there's still a lot of questions right now as to what is this going to look like long term.
100% of our GP team is minority or female. And so we are raising a traditional fund. We've done a lot to make that inclusive. I think the VCs that are in the market just have to do the work, drop your minimums. Raise your amount, and then once you're oversubscribed, just drop your minimum, fill it up to 99 LPs. That's what we did with our second fund once we hit our goal. And I have to say, I spent a lot of time educating people on even what an accredited investor is. If you own a home in Boston, you're probably an accredited investor. No one will give you a certificate. I had women whose CPAs charged them to write that they were an accredited investor in a letter and then give it to us. I was like, okay, so first step, this is not financial advice, but fire your secret. And I agree that I love all of the models that are coming out, but it's a bit of a land grab. And the thing that I do like about a traditional fund structure is fiduciary responsibility. And I'm concerned about what will happen with a lot of these DAO structures where it's not necessarily sure what the track record is or and who's holding that manager accountable for the deployment of assets.
I'll throw in on this one too. We started the first non-accredited investor fund in the United States. So, and we run a traditional venture fund in the sense that we do over-reporting and a lot of diligence, and we're backed by a big bank for that reason. And so I am a huge believer in this. I do have a lot of questions around DAO, especially with governance with investments, but also liquidity, which is a huge thing for us as well, because I think we're the closest thing in a couple of ways to that. And one of the things holding non-accredited investors is the idea of liquidity and running more like a mutual fund or a hedge fund, like in terms of how people think about what we do. And so we have a lot of extra reporting, and we're all stewards of other people's money. And so when you have a decentralized organization where people are kind of like, woohoo, we're just putting into this pool, like how much responsibility is put on the entire community to manage that? And then also on the flip side, what are they adding value to the companies that they're investing in, and who's adding value, and what's the governance of that, and like, when you have too many cooks in the kitchen, like what do you do with that? So I think it could be really interesting, but I also think to the same laws that are in place now apply to DAOs, whether you believe they do or not. So you still need to be an accredited investor if the DAO is investing in companies and private markets. So I think there's a lot that has to be figured out, and I wouldn't want to be on the backside of finding out that we're out of compliance with regulation. And I also really am concerned for the companies that are taking investment from DAOs, because how does that backfire on them in the long haul if something does go wrong? Because as an investor, there's risk, but as a founder, to take on the risk of the people who you invested in you, I think is problematic.
There's no follow-on yet from any of these micro funds that are trying on these different models. So you still have to integrate into VC at some point if you're going to go that route.
Hi guys. So I'm the lowly CPG person, non-tech person here with my brand Cleos, but unrelated but related question, because I have become very intrigued with Web3 and am I missing the boat and all this stuff. And I was just very curious on what you ladies think about kind of the ethical question of crypto, because I read this kind of intense article in the New York Times, really related to, I mean, we already saw what deregulation did with the mortgage crisis, right? And the question that in my mind was posed is, you've got major governments now making sanctions against Russia, and yet big cryptocurrency not doing that. So there's potential to get resources to, you know, a country that's essentially, you know, positing a third world war here because of the fact that there is no regulation. So I'm just very curious on what you ladies think about really the ethical question here, because I do tend to think that women are a little bit more morally conscious when it comes to making investments. So I'm just, like I said, related but unrelated. Very curious to hear your thoughts.
No, it's a really interesting question, and I think it all kind of comes back to your belief in decentralization and whether or not centralized entities are good. And I think there's like a lot of nuances within that, but I think like the benefits of decentralization and outweigh the negative impacts of, you know, what could potentially be going on. And I think, like, yes, there are going to be bad actors in the crypto ecosystem. There are going to be rug pulls. There is going to be fraud, and like you have to kind of you know, take that with a grain of salt. And also, when you're investing, realize that right now sometimes it's a gamble, and it's not necessarily you know, past performance isn't indicative of future results either. And so when you're thinking about these investments, I think also thinking of them as not putting all of your life savings into crypto if you're not willing to lose your entire life savings in crypto. So I think it does put a lot of onus on the individual to do their own research and to figure out what to get involved in. But that kind of lends itself to more decentralization. So I think there are definitely trade-offs.
Regulation is coming. I think Joe Biden made that pretty clear. And when Elizabeth Warren is yelling about other things, she's also making that very clear. I will also say crypto also got a lot of money into Ukraine very quickly and into Poland very quickly. And the whole point of blockchain is that you should be able to audit it. And the industry is not blind to that, and that is coming, and there are responsible cryptocurrencies with transparent practices there. So regulation is 100% coming. I would watch JP Morgan for this because they've been out in front of the regulatory side for a long time with blockchain.
Okay, I think since we came back to crypto, one question, this is something that I've been thinking about. I've seen a lot of protocols, a ton of protocols, but I feel like protocols are the precursor to actual applications and actual things being built. What are your thoughts on where this is right now and how much time there is before the crypto space is a space where somebody can go in and use a protocol, build something and expect the protocol to stick around so that somebody else can use it.
Yeah, I think we're there with some ecosystems. So Ethereum, for example, is a layer 1 protocol, and there's a lot of people building real decentralized applications using Ethereum right now. I think the problem with Ethereum is that